is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. The PBOC leaves its MLF rate unchanged and drains cash. While the Fed gets more reasons to delay cuts, equity markets are not liking what they're hearing as they look ahead to the BOJ. We hear exclusively from the U.S. ambassador to China, Nicholas Burns, about the bill to ban TikTok and curbing Beijing's access to high-tech chips.
The People's Liberation Army will take advantage of that technology to strengthen itself at the expense of the American military. We're not going to do that. We're not going to compromise on national security, and we're not going to negotiate.
Plus, an exclusive interview with the CEO of BOC Aviation, Asia's largest aircraft leasing company, which just announced record profits. Now, let's get you to markets and see how they're faring. Avril Hong is in Hong Kong, or rather here in the Lion City. Avril, we know that stocks and bonds getting sold off. We haven't seen this in quite a while.
Yeah, we are seeing a lot of red on the screen. I mean, if you think about how we got that hotter than expected US PPI, hotter than every economist's projections, is really raising those concerns of a hawkish tilt from the Fed. And as we wait for the US Central Bank to connect those dots, we are already getting the Chinese Central Bank keeping rates unchanged on the one-year MLF. This was as expected, but disappointing some corners of the markets that were perhaps holding out hope still of a reduction. So CSI 300, Hang Seng both down. Hang Seng dragged by the tech names, as you can imagine. You can see also in Australia, the financial, the mining-related stocks, those are the big losers today as we see iron ore still approaching the $100 a ton level. Now, on the Japanese yen and the Chinese currency, we're seeing that dollar story playing out. And the yen, as you know, Haas, is in a tug of war between the BOJ and the Fed. And the tiebreaker could come in the form of the Rengo today. Yuan, we saw the PBOC coming through with its strongest than expected fix since November last year. So it's really about central banks.
It is. And for the PBOC, MLF kept unchanged. It is keeping its powder dry.
Certainly not coming through with the stimulus. It was as anticipated, although there were a handful of economists that perhaps hoped for a rate reduction, including Bloomberg Economics. The idea behind this is, if you remember that reserve reduction, reserve requirement ratio reduction that was front-loaded by the PBOC governor, which came into effect in February, that kind of gave the signal that perhaps the governor is sitting up, paying attention to the importance of market confidence and fighting deflation. Ultimately, it disappointed the market, and it also drained cash from the banking system. So this is what we're getting on the PBOC's MLF. Let's flip the board because we also got data out of China on home prices. The declines eased, but it's still going in the wrong direction. And if you look at the new home prices, they've fallen for 9 straight months. You really get a sense that more support is needed for the Chinese economy here.
Ouch, not to mention that 5% growth target needing stimulus. Well, let's get more on markets. Let's bring in MLive strategist Mark Cranfield. Mark, so much room for disappointment, and PBOC started that already.
Well, as Avril mentioned, the most important point there was the withdrawal of cash. Now, although the equity market doesn't like it, they've reacted badly. This is mostly aimed at the bond market. The PBOC is concerned that the bond market has got overheated in China. Too much money has been flowing into government bonds especially. We have pretty close to an inverted yield curve in China, which is pretty a warning signal that things are not going well. But it's more a question of just too much speculation. What they're most concerned about is that particularly even banks are just putting money straight back into fixed income when they should be lending it to companies in China to get the economy going. So this is partly aimed at trying to break that cycle. They're trying to tell the banks, look, there's no more upside in bonds. Don't bother keep on buying bonds because we're not going to support that market. Please send your resources towards the real economy where we need it.
But it is about the timing of the move, the optics, and the messaging from the PBOC. It's not helping sentiment.
No, I mean, it's a very tricky balancing act because the equity market has rebounded a bit. They managed to put a bit of a floor in around the time of the MPC, but it's a bit of a fragile recovery, and so anything which takes away the mood slightly is not going to be good for the market there. So yeah, bit tricky from that point of view. The good news on the other side is that the so-called home team, who are the state-backed funds who have been supporting the market, they were very active going before the MPC, but gone pretty quiet in the past couple of weeks. So they've probably got a bit of room, a bit of ammunition available. Quite likely this afternoon we'll see them come in and do a bit of support for the market. That wouldn't be a surprise at all to end the week on a slightly better note. But whatever the PBOC do, they can't please everybody. They can't please the bond market and the stock market and the consumers all at the same time. They need help on the fiscal side and other areas as well. So very tough job, and they're trying to go right down the middle somewhere.
And tough job for the Fed as well. We have more reasons for the Fed to stand pat. PPI came in hotter than expected. Now talk is moving from 3 to 2. How might this all play out?
Well, for central bank nerds like myself, next week is just amazing. I mean, we haven't had the chance for the BOJ and the Fed to cause so much friction in the markets for such a long time. The range of outcomes is fantastic. If you think of, for example, you take dollar yen, the most bullish case for dollar yen would be that the Bank of Japan leaves everything unchanged and the Fed moves to 2 dot plots. That's BOJ being as soft as they can and the Fed being much more hawkish. Dollar yen goes much higher, likely. The other side of the equation is dollar yen goes much lower because BOJ goes all in. It comes out of negative rates. It gets rid of yield curve control, does the whole thing all in one shot, and the Fed stays with 3 dot plots for the rest of the year. That's a very soft signal from the Fed. The extremes for dollar yen are very big. Somewhere in between is probably the answer, but it could be a very exciting week.
What are we seeing in terms of positioning?
Still, yen shorts are still pretty significant in the foreign exchange market. They've come down a bit, but they're still very large. So there's definitely people who, on a scenario which is favorable for the yen, there's still a lot of people who need to cut exposure there. People have trimmed positions in the bond market as well, in the US Treasuries. It's a bit squarer than it was. That's partly why yields have been able to go up a bit this week with the PPI number being above expectations. So the room for volatility is pretty good because we don't have markets at really extreme point in terms of trader positioning. They're not at the kind of extremes which people would say, okay, well, it's all priced in. It doesn't appear to be all priced in.
When it comes to the BOJ, what are the key things markets are looking at? What are key things for FX and bond traders?
Well, certainly the big one, of course, is the negative rates. As we were talking about it this morning, that the way the headlines come through typically for traders to watch is the very first headline is Bank of Japan leaves the rate at minus 0.1%. That's typically so that whatever that headline is when it first comes out, traders will be jumping on that, and then following on from that, watching for the yield curve control. They tend to bury the messaging about yield curve control a little bit further down in the statement, so that won't be automatic. So that's often why you see dollar yen swing around, because there's a reaction to the first headline. Then people are waiting for a bit more meat in the story later on. So if they leave the rate unchanged, dollar yen could flip up first, and then they just say further down, oh, yield curve control is gone, dollar yen could go all the way. It's going to be volatile.
You know, you talk about volatility and concerns in the market about the uncertainty, yet we've seen big positions from the likes of Man Group. I mean, how much risk is there in doing that?
Well, I think people like them are taking more of a view on the medium-term outlook for Japanese companies, Japanese economy, and the equity market there, which is probably going to survive. Even if the Bank of Japan changes policy, it's going to be a gradual process. But the signs coming from Japan itself, they're benefiting a lot from this AI story. Japanese companies are back in the tech sector. They've reinvigorated themselves, and the investments going in there are stunning. If you look at TSMC, the Taiwanese company, is building a huge factory, and they're building another one as well. They've already finished one. They've got another huge project going on, and other people are putting money into Japan as well. And Japanese companies are getting better at paying dividends. That's a big step there as well. So the positive story there will survive whatever the Bank of Japan does. More risky one is, of course, if you're in Japanese fixed income. That is where it's going to get a lot more difficult.
Mark, rest well. It's going to be a big week next week. MLI strategist Mark Cranfield there. Now, U.S. Democratic and Republican senators are resisting calls to fast-track the passage of a bill that would force TikTok's Chinese owner to sell the app. The bill passed by the House this week demands ByteDance divest within 6 months or shut down the platform. Democratic Senator Richard Blumenthal says the deadline is too short, and Republican Ted Cruz wants a review that could tie it up for months. However, the Senate Intelligence Committee chair told us he supports expediting the bill.
They're collecting an enormous amount of personal data about Americans. The genius of TikTok, it kind of knows what you like even before you may know. And that kind of personal data, the 170 million Americans who are on 90 minutes a day, if you don't think that is a security risk or potentially you could be blackmailed at some future time by agents of the Chinese government, then I think you don't understand the unfortunate real world that we live in.
Meanwhile, the top U.S. diplomat to China has hit out against Beijing's objections to a possible TikTok ban. Ambassador Nicholas Burns spoke exclusively with our chief North Asia correspondent, Stephen Angle.
We've heard a number of complaints from the government here in Beijing this week about the American debate on TikTok. I find it supremely ironic because government officials here are using the X platform to criticize the United States. They don't give their own citizens the right to use X, to use Instagram, to use Facebook, to have access to Google. And so it is ironic indeed that the government here is complaining about a process when they shut down access for 1.4 billion Chinese to all of these platforms. Every country has a duty and responsibility to protect its national security. And what the president has done over the last year and a half is to make it impossible for sensitive American technology, advanced semiconductors for AI purposes, to be sold to China, because we know it will happen. We know that the PLA, the People's Liberation Army, will take advantage of that technology to strengthen itself at the expense of the American military. We're not going to do that. We're not going to compromise on national security, and we're not going to negotiate. And you can bet that the government here in Beijing is taking similar measures. They have not allowed, for most of the last 20 years, the export of core, sensitive, national security applied Chinese technology to the United States. And so, you know, every government, and certainly our government, has a right to take these decisive steps, and that's what we're doing.
I also talked to a lot of businesses, and we all know about the FDI numbers, foreign direct investment, down to the lowest gain since 1993. There is hesitation, not only because of the economy is weak, but also because of the myriad of different national security and the opacity of such policy, especially coming out of the National People's Congress. We didn't get a lot of clarity on policy. We do know, and you were in that 60 Minutes interview where you did talk about U.S. companies such as Bain and Company, Mintz, and others who have seen raids and they've seen arrests of U.S. citizens. Can you elaborate on the threat and the pall that has been cast over the investment community and doing business, Americans doing business in China at this time?
I think this is a question central to the U.S.-China relationship for the next year and the year beyond. We have a $575 billion two-way trade relationship. China's the third largest trade partner of the United States. There are thousands of American companies doing business here. Here's the problem. They're hearing conflicting signals. Some senior Chinese government officials say private sector investment is welcome in China, your investment will be protected. But then these companies are also hearing a different message, whether it's the raids against American companies of last March and April, whether it is the opacity of the counter-espionage law, where espionage is defined in such a general way that normal activities in any other country of the world, the collection of data, could be construed as espionage. And so we see American firms backing away, or at least being very cautious about investing a lot of money here because they're not sure where the lines are. And I think the voices that they're hearing from the government here in China about national security, they're the strongest and loudest voices right now.
And that was U.S. Ambassador to China, Nicholas Burns, speaking with our chief North Asia correspondent, Stephen Angle. Well, still to come, we speak exclusively with Stephen Townend, CEO of Singapore-based aircraft lessor BOC Aviation. We'll get his industry outlook and discuss the company's record profits later this hour. Keep it here with us. This is Bloomberg. In Investors hoping for rate cuts in the U.S. and China are now bracing for the possibility the wait will be longer than hoped. The PBOC held its MLF rate today, and Fed officials are preaching caution ahead of next week's policy decision. And the outlier, the Bank of Japan, could finally hike rates at its meeting next week. Let's look at how traders can hedge risk with Amy Patrick, head of income strategies at Pandal Group. Amy, the BOJ, the Fed, which is the bigger deal next week?
I think it's probably still the Fed. You know, we went into this year with such a lot of hope, right? We went into this year with, more than 7 cuts priced in for the Fed. And now we're pretty much back to where the dots are signaling. And every time we get more data from the US, and last night it was PPI, the market takes another couple of steps back from thinking, oh, well, we better wait a little bit longer now for those rate cuts that we were so sure of were coming by March, right, or May at the latest. And now even June seems to be off the table in terms of market pricing. I think it's the Fed that will inject the biggest volatility into the market, depending on how it sort of puts its hold position, whether it's a hawkish hold, is it a dovish hold. I think it's more likely to be a hawkish hold. But BOJ, yeah, certainly, you know, a lot of movements in the yen lately as well. But that trajectory is kind of painted well for us. It's a matter of when, not if.
For the Fed, Amy, it is about whether it moves from 3 to 2 rate cuts for the year. Are you anticipating that in light of, you know, all the harder than expected prints that we've seen so far?
Yeah, look, if I told you all of a sudden that, you know, if you didn't know where the Fed dots were, and I told you that there were no cuts priced for this year, and at the same time you saw where inflation was, where consumption was, where growth was in the US economy. You saw that the ISMs seem to be bouncing off their lows, which is an indication of where the manufacturing cycle is. And you saw that the housing sector in the US, despite interest rates at being 5.5% and long-end interest rates far higher for home borrowers, has actually started to turn a corner. Would you say that was unreasonable? If I told you there were no cuts priced in?
So having said that, Amy, I mean, how do you hedge your risk? I mean, it is a risky environment. There's so much uncertainty and a market price for perfection.
It is a market price for perfection, but I would argue it's more price for perfection on the risky asset side. And more specifically, I think when we talk about equities, quite a lot of the time we're referencing the S&P 500. And you've had endless debates on Bloomberg about whether it really is the S&P 500 or whether it's just the Mag 7 and then the rest of the S&P. So when you look at the way that risk assets have been pricing, you know, earnings expectations are still for solid earnings growth this year. Nowhere near an earnings recession. We think that that's already behind us, or at least the equity markets think that that's behind us. We're looking at, you know, risk premia indicators like the VIX and seeing that glued to the floor, despite the fact that when you look at other indicators from the Fed, like recession probabilities, it's soaring ever higher, right? So there is definitely dislocation in some aspects of the markets. And I agree with you, Haslinda. I think some asset classes are underpricing the risk and the uncertainties this year.
Right, VIX close to the floor, but gold at record levels. So that says something about risk appetite as well. Amy, I'm just wondering, how is your portfolio looking like right now? What are some of the changes you might have made?
So you might gather from the way that I answered your first question, if you were to play the tape back from when we last had our conversation, you'd see a pretty meaningful shift in my bullishness about bonds. For me and my portfolio tactically, this has been the biggest change. So at the end of last year, when the markets were busy pricing in, you know, 7+ cuts into the Fed curve, that momentum was really good for people who are really bullish on bonds. And at that time, we had a lot of indicators that told us not only is inflation coming off, but growth is likely to follow as well. I think for me, the biggest thing that has changed so far in 2024, as more and more pieces of data have come out, it's told me that because growth is so resilient in the US economy, inflation coming off by itself, even if I remain convinced on that as an investor, is not going to be enough to justify anywhere near the kinds of pricing that we saw at the end of 2023. As a result of that, my positioning on bonds is far, far lighter and pretty much almost flat, actually, in all of my income products. Instead, though, because the good growth environment tends to be really good for risky assets, I like credit more.
How are you looking at China bonds? They were the darling. That rally has pretty stalled today. We had the PBOC draining about $13 billion from the system, perhaps a way or signaling that it doesn't want money to be pumping into the bond market, rather the equity market. How are you reading all of these signals?
Yeah, look, we're still shy of that big bang stimulus approach from the PBOC or any other authority in Beijing, quite frankly. And we know that that's not going to come. I mean, when you look at all the things that they mentioned in the latest NPC, they haven't removed the 3 red lines from the property sector. And for me, that is the bar, right? If they're not moving on those, then the main engine that's fueled China's growth for the last 20 years is not going to fire back up. But what I see actually in China's economic indicators is actually near-term quite encouraging. So you're seeing credit growth start to base and turn around. And China is still very much fueled by credit. Even with the property restrictions going on, you're seeing good momentum in new floor space started in terms of construction. You're seeing land sales, while still in negative territory year on year, is getting less negative. All of these are encouraging signs that the Chinese economy is stabilizing. And when I think about where China yields should be right now, I actually think they ought to head a little bit higher.
So by the end of the year, do you expect Chinese assets to do better than the start of the year?
A year is such a long time with the Chinese economy right now. Like, structurally, nothing has changed, right? Structurally, the economy is still kind of closer to being on its knees than not. And I get asked this question a lot, even though I'm not a Chinese equities expert. But I would say, you've got large swathes of the stock market that are pricing so cheap. Most of the banking sector is valued below book at the moment. And you've seen that in the past in Europe. You've seen large swathes of the European banking sector in the depths of the Euro sovereign crisis, valued in the equity markets below book. But, that market has since recovered. I think with China, you really have to play the long game. I can't give you an answer as to whether or not the share markets will be higher than now by the end of this year. It's too hard.
Fair enough. Fair enough. Thank you so much for your time today. Amy Shear-Patrick of Panel Group. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back, and here are some top geopolitical stories we're following. The Biden administration has sanctioned 2 Israeli settlements in the West Bank and called on Israel to do more to end violence against Palestinians there. It's the second time since February the administration has imposed sanctions on Israeli settlers. Separately, U.S. Senate Majority Leader Chuck Schumer has broken with official policy in calling for Israel to hold new elections. The leader of Yemen's Houthi rebels says the group will expand their anti-ship attacks on Israel-linked ships in the Indian Ocean. He says the Houthis carried out 3 attacks in the Indian Ocean this week and won't stop until the war in Gaza ends. A shipbroker said this week that sea traffic using the Cape of Good Hope route is up 85% since December due to Houthi attacks in the Red Sea. And linked to that, let's take a look how energy stocks are doing today as oil rose to its highest closing since 2024. That's on the back of the IEA warning of a supply deficit throughout the year. It sees the oil market shortfall due to OPEC production cuts, and it sees WTI settling above $81 a barrel. Woodside Energy up more than 2%. China Oilfield Services also inching higher, up almost 3%. Plenty more ahead. Keep it here with us. This is Bloomberg. There you have it, Shanghai in all its glory. Welcome back. China markets just heading to lunch. It is a down day for the CSI 300 index, down about 0.6%. There is disappointment. The MLF was kept unchanged, but more importantly, the draining of liquidity, $13 billion worth by the PBOC. Perhaps it is a sign that it wants markets to start pumping in money, not into the bond market, but in the equity market. There you have it. Shanghai Comp currently down by 0.2%. The yuan at 719.64. It is flat versus the USD. Remember, though, the FIX has been very strong. In fact, it is the strongest FIX we've seen since, I think, November. So PBOC sending out that signal that it is comfortable propping up that currency as that recovery in the economy dwindles away. Shanghai off to lunch. Nikkei 225 back from lunch. And you know what? It is also a down day. Avril Hong is with the very latest. Avril?
Yeah, Haz. I mean, we're seeing how that U.S. inflation data, the PPI numbers, actually filtered through in the early parts of the trading session, already putting pressure on equities in Japan as around the rest of the region, but we are really on watch for the Rengo results. That will be key to whether the BOJ can start lifting off on rates next week. And as we're back from the lunch break, we're seeing the Nikkei managing to pair some of the declines of as much as 0.7% from earlier on in the session. It is today helped along by the energy and mining related stocks. Let's flip the board and take you cross asset because the Nikkei is flat, but we're seeing the topics, the broad-based gauge, manage to clock some gains. As I say, it's those mining-related counters. But there is so much at stake, and we have, ahead of the Rengo results, a BOJ former official weighing in, saying it's too close to call, but it could be the Rengo that pushes things to prompt a move from the BOJ next week. There is a lot at stake here. The blue chip gauge is hovering near record highs. The weaker yen, it's in the middle of a tug of war between the BOJ and the Fed. The Rengo could be the tiebreaker. And amid all this, it is helping the export-related stocks. Yields in Japan climbing. That's what we're seeing cross-asset in Japan, Has.
All right, Avril Hong, thank you so much. We're bracing for that BOJ meeting next week. Now, Asia's largest aircraft leasing company, BOC Aviation, this week posted a record annual net profit of $764 million. That was a steep jump from $20 million in 2022. The result comes as plane makers struggle to meet demand amid a global travel rebound. Well, joining us exclusively now is the new CEO at BOC Aviation, Stephen Townend. Stephen, good to have you with us. Record numbers. The question really is whether that is sustainable going forward.
I think it should be. I think if you look at the numbers we posted, so 764 million, as you say, which would beat our previous record high in 2019 of 702. In the core business, our revenues were at record high levels. Our cash flows are at record high levels. We did have some recovery in terms of the insurance settlements from the aircraft that were stuck in Russia. But I think what we're seeing in the industry now, as you just talked about, is that we're seeing record demand for aircraft.
Are your numbers a reflection of the aviation sector? Is it back to a healthy level, or are there still pockets of distress?
Globally, we're definitely back. Global traffic is now back above 2019 levels. We're seeing, even this week, Changi Airport reported that its traffic was back up above 2019 levels. Cathay Pacific announced strong profits this week. So I think most parts of the world now are back where we would have seen them pre-pandemic. The only trailing piece, I think, is that cross-border China market. China domestic is well ahead of where it was in 2019, but we're seeing that recovering as well. So I think we're seeing this continued momentum now of strong recovery in the industry.
You've had us talk about the Fed and expectations of an easing in terms of monetary policy. What might be the implications for lessors if we see an easing of rates?
So fundamentally, we're a leveraged business. Today we're levered at about 3 to 1. We're actually the largest corporate bond issuer in Singapore. And so our largest cash cost, our second largest cost is the interest expense. And so if we do see some easing in interest rates in the second half of the year, that should provide us with a bit of a tailwind as we move forward.
Even as you talk about how you're optimistic about the industry, there are hiccups right now in terms of supply chains, engine issues as well. How is that being impacted?
So we're seeing it across the industry, and this is not just a this year problem. This has been a multi-year issue. It's affected both Airbus and Boeing. It's affected all of the major engine manufacturers. What we're seeing is that supply of aircraft is not being able to keep up with demand. And so fundamentally now we've got this situation where traffic has come back strongly. Demand for aircraft is outweighing supply of aircraft, which clearly helps people like us that have aircraft available for lease. But what's unique now, I think, is that we have not seen this imbalance of demand and supply for almost 20 years. I think it was pre-financial crisis, 05, 06, 07 was the last time we saw the market where it is today.
But the thing is, it's happening at a time when airlines want growth. Give us a sense of how long these delays are and perhaps the impact, given that you're unable to collect payments for the jets already placed.
So firstly, on that point, aircraft that are already placed, people are paying. Our collection rate for 2023 was actually above 100%. So we not just collected what was due to us last year, but also some amounts that have been deferred from previous periods. In terms of supply, if you look at what happened during the last 3 years with the jets that Airbus and Boeing were unable to produce, we're short probably 3,000 to 4,000 aircraft on what would have been normally produced during that period. And so it's going to take several years to really catch that back up again. This is not just a 2024 issue.
When it comes to delays in deliveries, it also impacts the MAX. What are you hearing from Boeing in terms of how long that is, and what is it telling lessors like BOC Aviation?
So, firstly, this isn't just a Boeing issue. As I said before.
But what are you hearing from Boeing? What is it saying?
So, Boeing's challenge, right now, obviously, is that they have a cap on production, which the FAA has put in place, and that's going to restrain their ability to get back up to the delivery levels that they want to be at. And so we're going to continue to see delays from Boeing across the types of aircraft that they're delivering. But equally, we're seeing delays elsewhere as well in the supply chain.
And Pratt and Whitley engines impacting as well. So it's a double, triple whammy. Is there an area of acute shortage within the industry?
So the area of greatest shortage is that narrow-body aircraft, the 737, A320 sized aircraft, which is where we've seen demand come back most strongly, and neither manufacturer, neither Airbus nor Boeing, has been able to raise production back to the levels that they want it. Whether it's engine issues, whether it's production quality issues, it's issues across the board for the whole supply chain.
Stephen, we know that BOC Aviation has been pretty active in buying aircraft. Are there plans to buy more given the growth that you're anticipating?
We're always looking to add aircraft. The growth we had last year was about 10% year on year. We aim to continue that level of growth going forwards. Our order book today is about 224 aircraft that deliver basically from now to the end of the decade. But where we see opportunity to add to that, definitely we will.
Wide bodies, would that make sense?
It may do at some point. If I look at our existing fleet and order book today, we don't have a wide-body aircraft available until 2028. So I think what we're more likely to be doing in the near term is actually helping to finance airlines' deliveries of wide-body aircraft rather than ordering further aircraft ourselves.
Of course, this is an environment where geopolitical tensions are rising. Might that impact demand in the end?
We haven't seen it yet. We never know where these things can lead, but to date we haven't really seen that. We've seen demand come back strongly. We've seen demand for our aircraft globally now, and so whether that's coming out of the Americas, out of Europe, the Middle East, here in Southeast Asia, we're seeing it globally.
You're about, I think, several months into the job. What has been the biggest challenge for you?
I think so. I've been with the company a long time. I've been with the company 23 years. And so to a certain extent, it'll always be evolution rather than revolution. But it's always different once you become CEO. You now have to worry about everything. I think the biggest challenge for us, given the supply chain challenges you were just talking about, is maintaining that growth. I think we're in a good position, but we've got to make sure that we're able to maintain that now going forwards.
What is the ambition? 2-3 years down the road, where would you like BOC Aviation to be?
So at the moment, we are the largest in Asia. We're one of the top 5 globally. And certainly, strategically, we want to make sure that we maintain a position in those top 5 globally. And if I look forward to the end of the decade, then we probably need to go from being $25 billion today to 35 to 40 billion by the end of the decade if we're to be sure of maintaining that market position.
So what does that mean in terms of fleet size versus your rivals, for instance? Give us a sense of, the kind of growth that you're looking at.
So, what's our fleet size today? We've got in the existing fleet about 460 aircraft, 224 on order, so 684 in total. I think by the end of the decade, we have to be taking that closer to 1,000 aircraft.
And in terms of profitability?
We've been consistently profitable. We exist in a very cyclical industry. We've been around for 30 years and we've had unbroken profitability throughout that. There'll be some cyclicality in the earnings, but I think we can continue to build on what we've generated over the years and maintain a solid return for our shareholders, and importantly, continue paying our dividend.
Also, when it comes to the aviation sector, the price of oil, price of fuel is key, and we're seeing geopolitics weighing in terms of prices right now. What assumptions are you making about price and how that may impact demand?
So, from what we see today, we don't see huge variation in oil price. I think it's been actually more stable in the last 1 or 2 years than it had been in that prior period. And absent some big geopolitical shock, we don't see it trading much outside of that broad area that it has done for the last 1 or 2 years.
At least some stability amid all the challenges faced by the industry. Stephen Townend, MD and CEO at BOC Aviation. Thank you so much for your time today. Now, the U.S. Ambassador to China, Nicholas Burns, says channels of communication between the two nations' militaries are starting to open up. Here's more from an exclusive interview as the ambassador weighs in on U.S. alliances in the Asia-Pacific and Beijing's increased military spending.
The two presidents, President Biden and President Xi, agreed in San Francisco that we would begin again serious high-level communication between our militaries. This is critical.
Has it happened?
It's beginning to happen, and it's critical because our two militaries are operating in very close proximity to each other in the Spratlys and Paracels and the Senkakus and the Taiwan Strait. And so our new chairman of the Joint Chiefs, Chairman Brown, has had a discussion with his Chinese counterpart, and we hope very much that Secretary Austin will be able to talk to his counterpart in the coming weeks or months, and then we hope there'll be even conversations at a more tactical level between our militaries. This is common sense because you want to drive down the possibility of any kind of accident or misunderstanding between our air forces or our navies.
We do know at the National People's Congress, China increased the military budget by 7.2%, the biggest increase in 5 years. First of all, are you concerned by that, or how should we read that?
Well, what we're concerned about is the fact that the PLA is not transparent about how the money is being spent. You know, in the issue of China's nuclear weapons buildup, they're not transparent with the rest of the world, and that's a problem. And of course, the United States has been a principal military actor in the Indo-Pacific since the close of the Second World War. What we've been doing, and President Biden has had a lot of success in this, is to build up our alliances with Japan, the Republic of Korea, the Philippines, Thailand, Australia. We've created AUKUS, and of course we have the Quad with India, all designed to protect the democratic countries of this region and protect international law in places like the Taiwan Strait and the South China Sea.
We're also hearing that the Biden administration wants to and is exerting pressure on allies like the Netherlands, like Japan, like Germany, like South Korea, to further the curbs of other products into China. How does that not expand that pressure and actually bifurcate the relationship further?
We've been very clear that we adhere to a small yard, high fence scenario, meaning these are targeted actions that regulates AI investment by American companies in the AI sector here. These are common sense actions by the United States. Any American government would have to take this action given the competition we have underway in the military sphere between the People's Liberation Army and the United States. And I don't think there's an American alive who would say that we should sell advanced technology to the PLA. So the president's acted in the national defense here, and as I said, we're not going to negotiate or compromise on this. And these are the actions that a government has to take to protect in the 21st century. In an age when technology is at the heart of international politics, some of it has to be regulated.
U.S. Ambassador to China, Nicholas Burns, with our Chief North Asia correspondent, Stephen Angle, in Beijing. Now, India starts trading in just under 15 seconds. We know that there's been a lot of funds buying the dip in India. We saw a record amount by local institutions worth more than $1 billion on Wednesday alone. Small caps, the recent darlings, are down more than 7% this week, and that's on the back of consolidation. Of course, some stocks we're watching today include Paytm, and Paytm winning key payments approval it needs to stay in business, and that's according to some people familiar with the matter. The National Payments Corporation of India, in fact, said that lenders the likes of Axis Bank, HDFC, State Bank of India, Yes Bank will power peer-to-peer or UPI payments on Paytm. Today, though, the Sensex index under pressure, down 0.4%. Losses too for the Nifty as well as the Nifty Bank Index. Well, still to come. India's elections watchdog reveals Prime Minister Modi's party was the biggest beneficiary of now banned electoral bonds. We'll follow the money trail. Keep it here with us. This is Bloomberg. India's elections watchdog has released long-awaited data on corporate contributions through now-banned electoral bonds. Top companies, including Vedanta and ITC, are on the list, with Prime Minister Modi's BJP receiving almost half of total donations over the last 5 years. Well, for more, let's bring in South Asia government reporter Swati Gupta. Swati, what have we learned from this data so far?
So we've learned that millions, hundreds of millions of dollars have basically moved between donors and political parties using these electoral bonds. The electoral bonds work in a way which creates this opaqueness around who's contributing money and where that money is going to. Basically, using a government-owned bank, they work as paper instruments which are officially going through the channels, but your regular voters do not know where the money is going and if there is any quid pro quo involved in the transaction. So we are seeing that political parties have received hundreds of millions of dollars in donations through these bonds.
And these are big names. Perhaps most surprising, who wasn't on the list? And the flagship firms of Mukesh Ambani, Gautam Adani, they're not?
No. The data that the Election Commission released last night, it lists a lot of big names. You have Cipla, you have Bharti Airtel, you have Vedanta, but it doesn't list the more obvious names, which are Ambani and Adani.
Swati, thank you so much for that. South Asia government reporter Swati Gupta there. Plenty more ahead. This is Bloomberg. Japan's largest union group will release the most closely scrutinized wage figures in decades on Friday. The numbers may be strong enough to nudge the central bank toward raising interest rates for the first time since 2007. And ahead of that, Suntory Holdings president and CEO Takeshi Ninami told us why he's in favor of continued pay hikes.
Before summer, I think we have a huge opportunity to be able to raise prices. But after summer, we don't know about that, because how we can keep the current above 3% inflation, that is sustainable or not. And that's the sharing concept between us, business, and BOJ. So we have to keep raising wages for the next years to come. So that's another issue we have to discuss.
You've talked a bit about the weak yen. Over the past few years, we've seen the yen weaken a fairly substantial amount. What's your view now on the yen and where it is and how businesses navigate through this changing currency environment?
Okay. First and foremost, to what extent will Bank of Japan ease the monetary policy? I don't think they want to ease the policy, the monetary policy, and unleashed. And I think they will change the from negative to positive, but slightly. It doesn't mean they want to unleashed. I mean, they get the monetary policy unleashed. So which means the still Bank of Japan will keep the easing policy of monetary policy, and that means won't be changed. But key factor is the Fed. The Fed will lower the interest rates 3 times, 4 times. To what extent? So I'm sure the current level will be not sustained. Perhaps the 140 or 135. So 150 is the cheapest, but the weakest. So, but the trajectory is not so much volatile in terms of the value of yen.
I see.
And that's needed for business. Because the volatility is the major risk for us. So let's say 135 around and 40.
But down from here.
Right, that's right.
A bit.
That's right.
You make the point.
Depends on Fed as well, not the Bank of Japan.
You make the point that the priority is the economy and the health of the economy going forward, not exactly where the currency is. And the Bank of Japan won't make these decisions in a vacuum. They have to be aware of what the Fed is doing. So the Bank of Japan can move out of negative rate territory, but partly how far they can move will depend on what happens in the Fed and other central banks. Is that your point of view?
Let's take a look at the long term. YCC already dismantled. It's about the 1%, means it's now standing around the 0.7 or 6. So up to the market already. So now already the messages were given to the market. I think the current market, money market, is based on the messages given by the Bank of Japan, which is not unleashed, but to some extent. And the negative rate will be dismantled.
Suntory Holdings President and CEO Takeshi Minami speaking exclusively to Bloomberg. Let's take you to market. Some of the movers that we're tracking right now, Samsung among them. Chip-related stocks, Samsung set to win over $6 billion from the U.S. under the U.S. CHIPS Act, and that's according to people familiar with the matter. They say that money will help Samsung expand beyond its project in Texas. It's said that Samsung rivals like TSMC, Intel also set to be awarded that grant, not lifting Samsung shares right now, currently down about 1.6%. TSMC also in negative territory. We're tracking Honhai, surging more than 8% right now after profits soared 30%, boosted pretty much by its AI hardware sales. Shares up about 15 or so year-to-date. Traders, analysts see it gaining a growing share of the AI business. Take a look at where we are in terms of GMM. Of course, it's trepidation red pretty much across the board as we await the BOJ as well as the Fed. That is it from Bloomberg Markets Asia. Daybreak Middle East is next. Keep it here with us. This is Bloomberg.